Before we begin, please be advised that trading foreign exchange and financial products involves a high level of risk. This content is strictly for educational purposes and does not constitute financial advice. You are solely responsible for your own investment decisions. Welcome. Today we will break down a live trade on the euro to US dollar pair by analyzing institutional liquidity. On the daily chart, our priority is identifying liquidity pools. Notice how price moves between unmitigated supply and demand zones. These equal highs at the top represent accumulated buy-side liquidity, while the lows at the bottom act as magnets for sell-side liquidity. This time frame is our compass. Understanding the macro bias is the first step before dropping down to microstructure to find our entry. Dropping down to the 8-hour time frame, the narrative becomes much clearer. Look at the blue arrow. It points to a strong rejection candle right after sweeping internal liquidity. This move isn't a coincidence, it's profit-taking and order grabbing at the previous day low, PDL. The extended lower wick confirms that institutions are defending this zone, rejecting lower prices to maintain the bullish structure. Identifying this rejection is crucial, as it gives us the first signal that the order flow is ready to shift. Before we move on, a quick clarification. Although we analyzed the initial rejection on the 8H, these highs are more accurately visualized on the 4-hour time frame. As you can see, the price is forming consecutive lower highs. By selecting these liquidity zones on lower time frames, we finally get a detailed map of the price direction. These descending highs tell us that selling pressure is displacing buy orders, setting the stage for an expansion toward the lower liquidity levels we previously identified. Moving into the 1-hour time frame, the level of detail increases significantly. You can observe how, after the series of lower highs we tracked from 4H and 8H, the price has now marked a higher low in this area. This level, highlighted here, is vital to understanding whether the price will maintain its momentum or if it will seek the previous day low marked in red below. On the 1H chart, we begin to see the real struggle between supply and demand. These local support levels serve to filter out fake entries and confirm if macro liquidity remains our primary target. We are now on the 15-minute time frame, right at the New York session open. Notice the blue arrow. The price has generated another sharp rejection. What's most interesting here is the formation of two highs at the exact same level, creating clear resistance. These equal highs are a classic liquidity trap. While retail traders see a double top to sell, we understand that above those levels lies accumulated buy-side liquidity. The price is setting the ideal stage, a previous rejection and exposed liquidity just before the real move occurs. Staying on the 15-minute chart, it's time to draw our Fibonacci tool to identify high probability zones. We mark the range from the structural high to the recent low. Notice the purple box. It spans from the 50% to the 78.6% Fibonacci levels. This is our premium zone. We are looking for the price to retraces to this point to balance out before continuing its expansion. By aligning these levels with previous highs, we have a perfect institutional supply zone to look for our entry confirmation. We scale down to the 5-minute time frame to look for our execution. Notice the precision. The price has finally entered our Fibonacci zone and is reacting to the 5-minute order blocks we've marked in green and red. This confluence is pure gold for a trader. We have the retracement to the equilibrium level, internal liquidity capture, and the validation of an institutional order block. The entire map points in the same direction. We are at the moment of maximum probability, where risk is controlled, and the lower liquidity target is getting closer and closer. We further refine our view on the 3-minute time frame. We are at the epicenter of the large investors' trading zone. Notice how the upper order block is acting as an insurmountable resistance right now. The price attempts to move higher but is systematically rejected, leaving wicks at the top of the candles. This is a sign that supply is absorbing all available demand. Everything indicates that the price is about to make a definitive decision, to begin the bearish displacement toward our lower liquidity targets. Finally, on the 1-minute time frame, we make the decision to execute. It's time to enter the market. Take a look at the position. Although price shows clear resistance at the order block, I've decided to set a slightly wider stop loss than usual. In this high volatility zone, we need to give the trade some breathing room to prevent a final institutional wick from tapping us out before the real move. We are prioritizing position survival over an excessively tight ratio, trusting that the bearish direction toward the 1-hour low is the path of least resistance. We continue to monitor the development on the 1-minute timeframe. As you can see, the price is hovering dangerously close to our entry point, revalidating the order block once again. This is where psychology plays a fundamental role. I'm sticking with the decision for a wide stop loss above the local highs, although it may visually look like a risky zone. Technically it's what protects us from manipulation. We shouldn't panic if the price doesn't drop immediately. In institutional trading, patience is what pays, and as long as our liquidity thesis remains intact, the trade stays alive. Patience is starting to pay off. We are still on the 1-minute time frame, and we can see the price finally leaving the trading zone, starting a solid bearish displacement. As we anticipated, the upper order block acted as an insurmountable ceiling. Now, the price is moving with determination toward our take profit, marked in green. By keeping a wide stop loss, we survived the initial noise and are now in a winning position. The objective is clear: the liquidity residing at the previous low is our final destination. The price action on the 1-minute chart has just given us the confirmation we were waiting for. Notice how this latest candle closes with a solid body, clearly breaking below the last higher low we had identified. This structural break indicates that the short-term bullish sentiment has been invalidated. We no longer just have a rejection at the order block, the market is now creating a new bearish structure. With the path cleared and momentum on our side, the probability of hitting our take profit before the session ends is extremely high. With the price aggressively breaking the last low, it's time to apply active position management. As you can see on the screen, I have moved my stop loss to lower levels, now placing it below the original entry point to secure the trade. By doing this, we eliminate financial risk and turn the trade into a risk-free position. In institutional trading, it's not just about predicting direction, it's about managing emotions and capital intelligently while the price moves inexorably toward our final target. Watch this move on the 1-minute timeframe. The price makes a quick retracement, what we call an internal liquidity sweep or inducement. This move aims to shake out traders who moved their stop loss too early. However, after grabbing those orders, the price plunges again with much greater force. This acceleration confirms that the bearish bias is absolute. The displacement candle we are seeing now is the signal that large participants are injecting the necessary volume to sweep the last support levels before reaching our target. Finally, the target has been met with absolute precision. Notice how price sliced through the final fair value gaps on the 1-minute chart to hit our take profit surgically. This trade is a perfect example of why patience and institutional liquidity analysis are superior to any lagging indicator. We successfully navigated the New York session noise, protected our capital at the right time, and allowed the macro narrative from the daily chart to dictate the outcome. A solid risk-to-reward ratio executed with discipline. I hope this step-by-step breakdown helps you improve your own market reading. I will continue to provide educational content and live trades every day so that together we can master the language of price. If you enjoyed this tutorial, don't forget to subscribe to the channel, hit the like button, and share this video with other traders. If you have any questions, leave them in the comments. I always respond to the community so we can keep growing. Thanks for watching, and I'll see you in the next session.